Welcome to Pride Partners International's monthly webinar. Thank you for joining us today. Pride Partners International is a global partnership of firms and specialists in transfer pricing and financial valuation. The association is the meeting ground for professionals capable of facing a challenging business environment, helping them connect to boost their continuous professional development and enhance their technical and human skills and abilities. This partnership is made up of experts recognized by their trajectory and prestige in the transfer pricing and financial valuation fields. Experts that constantly participate in the exchange of technical information, knowledge development, and implementation of global best practices. When a firm joins the PPI partnership, it increases its scope immediately and exponentially. Business becomes much simpler by accessing training, technology, resource optimization, and new business opportunities, among other benefits. We invite you to learn more about Pride Partners International. Contact our agents and be part of the global elite of transfer pricing and financial valuation consulting. Our transmission will begin shortly. We invite you to participate actively by sending all your questions or comments through the live chat. Again, thank you for watching, and we hope you enjoy the event.
Hello, everyone. I'm Jim Toomey, a subject matter expert in transfer pricing. I work with S&P Global Market Intelligence. S&P Global Market Intelligence brings transfer pricing solutions on a global basis to countries, clients, and corporations throughout the world. I'd like to thank Pride Partners International for putting together this presentation on taking a look at intercompany transfer of financial transactions and loans. Today, we will be discussing how to determine the arm's length risk associated with a subsidiary or tested party, the role of parental support, also known as implicit support. How do you determine an interest rate that is appropriate for that rated risk entity that we are taking a look at? The debt capacity analysis of the tested party or entity or subsidiary which we are reviewing, and the recovery rates or the loss given default for individual financial instruments. Now, whenever you're taking a look at interest rate pricing, it's not always necessary to follow all of the same processes as an independent lender. For example, a corporation may not need to go through the same process of information gathering about the borrower's business, as the required information may already be readily available. However, in considering whether the loan has been made on conditions that would have been made between independent enterprises, the same commercial considerations must be taken into effect, such as creditworthiness, credit risk, and the economic circumstances. Standard & Poor's Global Market Intelligence provides credit analytics to measure that counterparty risk, to determine what is the standalone risk rating of an entity, and to also delve deeper into delivering an interest rate calculation based on corporate yield curves, and also the recovery rates, should there be any default. Now, what is the current environment that we're looking at? Well, the OECD in 2015 came out with their BEPS project, Base Erosion and Profit Shifting, and they came up with a series of actions, 15 actions, which were delivered on a global basis in order to recognize revenue that was being shifted to other places of nexus and which had the right to tax that. So the OECD has recognized that this shifting of the tax base is inappropriate on a global basis under the legacy rules, and so came up with the first BEPS project. These right here are a listing of all of those BEPS action items which were completed in 2015, or initiated in 2015 and just recently completed in 2020, with the last piece, which is transfer pricing guidance on financial transactions on actions 4 and 8 through 10. This is where Standard & Poor's has focused much of our attention on a solution in order to determine that risk-free rating of an independent entity and how to determine interest rates. Now, there have been many cases involving financial transactions, and the risk associated with these cases is very, very high. Here are some legacy cases. I would point out the Australia ATO versus Chevron Holdings, which did result in a multi-billion-dollar recognition because of an inappropriate documentation and transfer of an intergroup loan to an Australian entity. When we take a look at all of these cases, you have to know that your clients have a high degree of risk that can be associated with financial transactions. And we have seen that financial transactions are now becoming more a part of the landscape. The Financial Transaction OECD action paper, which was released in February of 2020 on financial transactions, is the last paper associated with what we would call BEPS 1.0. And why was it the last one? Well, financial transactions are many times the most difficult to understand and to delineate when going between related parties. Now, the OECD has come up with what we now call BEPS 2.0, and the 137 member countries of the inclusive framework on BEPS have now put out another position paper, which just came out in October of 2020, that consists of 2 pillars. Pillar 1, which amends the profit allocation and nexus rules to give market jurisdictions where consumers are the ability to pay taxes. And Pillar 2, which calls for a global minimum corporate taxation. So that will be upcoming from the OECD. Now, when we take a look at an entity, S&P Global Market Intelligence has a transfer pricing intercompany financing methodology, which has been confirmed by the OECD and by years of rating companies in the public realm and rating public debt. We can perform an independent credit risk assessment. We can determine that arm's length pricing using our corporate yield curves, and we have the methodology to develop detailed reports for you. Now, the first item, as we have discussed, is the standalone evaluation of the borrowing entity. And the pricing begins with an evaluation of this standalone credit risk. We have 2 different models which are available: a probability of default, which are called PD fundamentals, as you will see here. And then we have a credit model, which we have developed in association with Standard & Poor's ratings. This model takes a look at an amalgamation of all of the ratings which Standard & Poor's has done, and takes a look at the cohort within each one of the individual ratings based on industry, currency, and financial information. When we take a look, both of these models align very, very closely. The probability of default for fundamentals is been based upon back testing, going back numerous decades and finding those companies which have gone bankrupt due to liquidation or buyout or other events which would cause an entity to be delisted and be declared in a state of bankruptcy. Now, the model allows you to go within any country, and we do take a look at individual country risk analysis into any industry based upon the Global Industry Classification Standard, or GICS, which Standard & Poor's promotes as a unified global industry classification system. We can go back in time, which is critical, and especially when you are under audit, you need to go back and recreate the results exactly as determined at the point in time in which you are making the initial assessment. And we have all of the currencies available on a global basis in order to assess the currency risk cross-border and within the country itself on the ability to make the payment back to the parent. This is an example of a credit analytics score, which can now be generated to test that standalone risk profile of an entity which we're taking a look at. In this case, we see that the probability of default is 0.3118%. We disaggregate the business risk from the financial risk, and we'll tell you the sensitivity of each one of the characteristics so that you can do what-if analysis to determine what if we change the capital structure of our entity, or what if we infuse cash into a equity position? How would that help our credit rating? This credit rating will now come along as a standalone rating. In this case, we see BBB-. They're in lowercase letters, so that denotes that this has not gone through the qualitative review by an S&P analyst. Although we do allow you to make qualitative adjustments based upon your knowledge of the diversification of the subsidiary, the quality of management, and the payment behavior. Here we see that we're taking a look at Empresas Copec, which is a Chilean company. We will, in red and in green, for positive and negative portions of the risk assessment, give you information on that entity and go through the risk driver analysis to tell you where you would be able to more effectively impact an increase or decrease in that standalone score. Now, here are those qualitative adjustments which we discussed at the very top, based on diversification, whether you're a diverse company in terms of geography and different industry segments, your quality of management, whether that's going to be good or bad, or novice or very experienced, and then payment behavior, whether that is constant or erratic. Now, we also have the ability to go through and take a look at what we termed parental support or implicit support. And the implicit support is specifically mentioned in the transfer pricing guidance on financial transactions. We can see here that a multinational entity is assumed to receive solely by the virtue of group affiliation implicit support from that group that will be part of the assessment when taking a look at the risk characterization of your tested party or your subsidiary. Here we can go through, and because Copec is owned by Arta Chile SA, we can now easily go in and apply a parental overlay based on the yield approach, which is a confirmed approach by S&P and recognized by the OECD as an appropriate way to measure that implicit parental support. By putting in the public company information, we can auto-load all of the financial inputs which are required to make a determination of where that parental and group affiliation would actually add to or neutral or negatively affect the credit rating. Now, after this has been loaded in, we can see that yes, on a standalone basis, we were a BBB minus, but now we have gone up one notch using the parental support or the implicit support of the group to a BBB. So now we know that the implicit support of the group is a positive for the base case which we are making with the company that we are reviewing currently. Now, we standardize the content in our corporate yield curves in order to assess what would be the appropriate market-driven interest rate to charge this entity for a loan. We take sources from FINRA Trace, Trax, S&P Capital IQ, IDC, and take all of these parse quotes from buy-side firms. We look for the highest consistency of pricing for individual bonds. Now, some people might say you should go to the loan market in order to look for this information. But the loan market does not have very good information. It's not global. There's not a lot of terms and conditions which are always available within the information sources that are out there. And many times loans might really not have that same arm's length characterization that those bonds that are in the market and trading actively with different activities would represent as a market-driven determination of how we should price that bond. Now, after taking a look at these bonds that come in to S&P, we take a look at the number of trades or quotes, and there must be at least 4. If there's less than 4, it is not considered within the corporate yield curve. If it's 8 or above, we give it 100% weight, and 4 to 8 is linearly weighted. So for example, 6 would have a 50% weight within the corporate yield curve. They must have a rich turn structure. We then divide these into our 11 sectors according to currency and maturity, and we many times have credit quality associated with these bonds, so we have a Standard & Poor's rating also available. With all of this data and the parsed quotes, this is our clean input data. We filter these that are specifically with bond issues that have frequent daily updates, and we determine the curve shape and the curve level. We combine the spot curves to get the credit spread, full yield curves. We are also able to determine the Z-spread associated with each one of these curves. And then we draw these curves so that we are able to determine what are the appropriate market-driven interest rates for each one of the entities which we are taking a look at, and their quantitative rating, which has been derived from either our probability of default or our credit model score within the S&P framework. Here is an example of our corporate yield curves. In this case, we're taking a look at a Mexican oil industry, and we can see that not only has the curve been drawn, but we also have the upper and lower ratings available so that we can take a look at spreads. We will price that loan. Here we can see that a 5-year loan would be at a certain interest rate, but we will also tell you the Z-spread. Now, the Z-spread is that basis by which you can take a risk-free loan, whether it be LIBOR or whether it be a T-bill. In the US, it might be a US 10-year T-bill, which would be determined to be the risk-free rate of return. And then you can add these, the Z-spread to that curve in order to determine a floating rate that would come back according to the market-driven yield approach for finding who would be the most appropriate comparables listed here. That's a list of unique security issues, and what the interest rate is being paid, what is the Z spread, what is the yield to maturity, what is the coupon rate. All of the data is available. So here we choose as one of our comparables Petróleos Mexicanos, engaged in exploration, production, refining of crude oil and natural gas. This is a good comparable. It fits exactly with the company that we are currently evaluating, our subsidiary, which we have out as a tested party, and we now have loans based upon subsidiaries, based upon Regulation S filings within the Eurobond market, based upon 144A filings to the Depository Trust Corporation. All of these are available to us so we can take a look. We have the business description, which is always critical whenever we're doing any of our documentation, is to have very complete business descriptions to make sure that our comparable as the functional and risk assessment that is comparable with the entity which I am reviewing. Now, not only do we have the business description, the interest rate, the Z spread for each one of these, but we also have the individual tagged ISINs. These are the security identifiers for each one of the bonds. So now you're able to find that specific bond, read the terms and conditions, read any information that would make it comparable or non-comparable to the specific transaction that you are making on a financial basis with your tested party. And you can go through, and now using our database, you can go specifically to that issue that is available. You can find the coupon type, the maturity date. All of this data is now available. You can also screen for this data within the database. So if you have all of this information already known, you would be able to screen the database to find those companies which fit your criteria specifically for your financial transaction that you are now initiating with your tested party. Now, the interest rate pricing, you start with the premise that maybe your treasury function is a service provider for your group. You then go through and use the verified credit rating methodology endorsed. Keep in mind that when you go out and you're using these black box models, they're very difficult to audit. You do not know the underlying comparables or the ISINs that are associated with each bond. We go through and give full transparency to ensure consistency within a global range so that you can apply this to the same policy, the same methods, the same application of implicit support, and the degree of substance required. You also have the ability to replicate these terms and conditions on internal loans given to third parties. You also might have an additional burden to monitor these with other covenants and to test other clauses, but all of this information is now available in one source for you to be able to access quickly and easily. What you really need long-term is a consensus on the practical guide for credit rating and interest rate pricing and your appropriate loan terms, as each one of these degrees of substance is required in the borrower and the lender territories. So now we have the consistency, We have the archive data so that you can reproduce this data and content easily and quickly. And if you come down below, we will see at the very bottom of the screen here, document name. We provide links to each one of the bond documents that automatically will bring up the content as to where the terms and conditions for each one of these bonds has been published with each one of the appropriate security exchanges on a global basis that track the content of all of the data that is being driven from each one of the bonds. Now let's talk about debt capacity analysis. Many times we are going to run into features, whether it be thin capitalization or other components, to determine that our subsidiary is appropriately capitalized in accordance with the arm's length principle. We would also like to know, can the subsidiary service its debt obligations? Can the subsidiary borrow the amount of debt given the current market conditions? And is the financing transaction priced in accordance with the arm's length principle? Using a financial comparables analysis, we contrast industry-specific leverage ratios, the debt service capacity, and the profitability parameter. As you can see below here, we are taking a look at the interquartile range of a standalone entity and taking a look at those profitability, liquidity, and leverage ratios. We will determine where does our tested party fit within an appropriate set of industry comparables on a global basis, and is this subsidiary capitalized accordingly. We can also do analysis on the credit assessment of the subsidiary itself. Once again, we use a quantitative credit risk measurement. The issuer ratings are from the credit risk agencies such as S&P are the base of our analysis to determine this peer group. We look at it on a regional and industry consideration. We can take into effect the parental overlay on the implicit basis. And the OECD BEPS guidance supports both the views of parental and implicit and standalone, so that we can take a look at each one of these entities and compare it to a group of companies that are in the same business. Now, knowing this, we can now see, where does my entity stand? And we have a nice graphical determination to see if those components, long-term debt to capital, long-term debt to equity, CFO coverage interest, net debt to EBITDA, and return on capital, along with EBIT margin, are now within the interquartile range based upon those components that S&P uses in its risk analysis for determining the quantitative basis of our determination of the risk assessment. Here it looks like we have a little bit of work to do. Although being above or outside of some of these may be a positive depending on the ratio itself. Now let's talk about loss given default. One of the critical components that have come up from the determination of the guidance is not only the determination of the multinational entities and the subsidiaries' risk assessment, but the assessment of the individual issue itself. And so when we take a look at the credit rating of a borrower or the credit rating of an issuer, we many times may not take into account the actual entity level individual risk assessment of the security that is being created within the framework of the loan itself. So here we can see that S&P not only has a loss given default model, which allows us to derive the individual risk assessment, but we also have a recovery model. That recovery model is available for you to review, and using S&P guidance, you can now determine, based upon the recovery rate percentage, whether it's 70 to 80%, 80 to 90%, you can now estimate, and using S&P guidance, increase or decrease the number of notches on a standalone basis for that individual security that you are viewing. In this case, we made up a exposure ID, 1, 2, 3, 4, 5, 6. The name, COPEC, $30 million US dollar subordinated. S&P has different models. We have a discounting method that you can take a look at over time, different models, but below that, we have a bond light, a loan light, several different models which we can supply working white papers to you upon request after the presentation is over. In this case, I chose a bond light model, and as the debt type, I'm going to make this a subordinated bond. Now, for demographics, there are only certain sovereignties which have the kind of information which is needed on bankruptcy and debt filings. We have all of those available within the database, and in this case, I used the United States of America, which we found has the most complete information on bankruptcy and debt due to the size of the debt market. So we have now a regional default rate and an industry factor that we can determine based upon a $30 million US loan, which is a subordinated bond in the terms of its hierarchy as taking a look at the entity itself. Given this, we can now go through and determine an expected loss given default, which would be $20 million, and all of the model assumptions, which are critical for tax authorities and regulatory required agencies to review. This is all based upon public established data that is available in the public marketplace and is easily recreated based upon audit. So, with all of these components, we have the documentation piece, we have the piece in order to establish our risk-free rate of return. We have all of the information to determine the standalone risk assessment of an entity. We have our corporate yield curves, which are now available to go to the public markets and find an appropriate bond which would be comparable to the information which you are now inputting for your subsidiary debt. We have the individual down to the entity individual level of the risk associated with that individual loan that you are making, the recovery rate, the bond information, which is publicly available and recreated, and all of the transparency which is required in order to do your intercompany loan and financing. And with that, I am going to let you know that any information available here, we can discuss further with you. If you do have questions, if you please reach out to the link, which will be available after this is over. Thank you for your time, and please let us know if you have any further questions.